Okay, we are 6:02 by my count, so we'll make a start. Still quite a few to join, so they can come on through as they arrive. But thank you everyone for joining us this evening, or wherever you may be in the world, either good morning, good afternoon, or good evening. We've got both Joel and myself. Joel is based in Perth, and I'm sitting here in Singapore, so we'll both be chiming in, covering different topics as we go through this evening. Hopefully everyone will get a lot out of it. We've got both the chat and the Q&A boxes running. So any questions you think of as we go through, chime in, drop us a note. If they're sort of short and we can cover them at the time, we will. If they're a bit more in-depth or detailed, we might leave them until the end, but feel free to fire them through at any stage. We'll keep this interactive. Hopefully everyone will get a lot out of the session. We've got lots and lots to cover. So yes, you can let us know at the end, but thank you very much for joining us. Now, before we get started, let us just inform you that everything you hear on this webinar or see throughout this webinar is purely for your entertainment. This is not personal advice. You will note that your name is not mentioned anywhere in this document, nor will we say your name. So if you need personal advice, reach out to Joel and or myself, and we can go through that with you. So hopefully you'll find it informative and entertaining, but it is all just general information to give you things to think about. So enough about that. Let's cover the WIFM. So what is in it for me? What are we hoping you'll get out of this evening? What are we going to cover? So we'll share very briefly a little bit about the two companies. So both Ally Wealth Management and Australian Expatriate Group, or GFC, here in Singapore. We'll cover off a bit about that. A bit around superannuation. There have been a few changes. There are some very handy tools there, strategies there for you to be aware of. I note that the majority of people on the call or on the webinar are expats, which is great. We don't have, well, from the poll at least, we don't have any residents on the call, but I'm sure Joel will share a little bit around what you might need to think about. I know a few of you have said that you're thinking you might go back to Australia in the next 1 to 2 years. So even though they may be things that may not impact you right now, probably some very handy tools to be at least aware of. And no doubt they'll change before you go back anyway. But at least you know what they currently are. We'll give you a bit of an update on the tax residency. This is always front and centre, particularly when it comes to Australian expats. Everyone is a bit concerned, a bit worried, and rightly so for a lot of people when it comes to the tax residency changes. So we know a little more there, but just not quite everything. A little bit on the property front. There have been some changes, some announcements, some terrible ideas that thankfully didn't see the light of day, but we'll cover off a few things there that have been discussed at various political levels, particularly in Queensland and New South Wales. A little bit around tax management, tax planning, tax strategies. No Australian, wherever they may be in the world, likes paying tax. So naturally, that's going to form part of our discussion. And then a bit around where we're seeing opportunities in this market. I think when it comes to the media at the moment, you know, the phrase, if it bleeds, it leads, is very true at the moment. And, you know, you look at why there is so much crime in every news report at the moment. Naturally, bad news sells, and it is everywhere at the moment, but that also highlights the fact that there are some great opportunities. So we'll cover a bit about that as well. But a little bit about us, a little bit about the company, and who Joel and I are. As I said, I'm Jarrad. I am a shareholder in Global Financial Consultants. We look after the Australian expat division here in Singapore. And we work with Australian expats all over the globe. So hence Joel and I work very closely together with our clients' onshore, offshore strategies, with everything from insurance to investments to tax planning to global portfolio management to tax residency, etc. There is a great deal we'll cover. You'll hear a bit of a snapshot of that as we go through. But Joel, over to you. I'll let you tell everyone a bit about yourself and Ally.
Thanks, Jarrad. So my name's Joel Kerin. I'm the Senior Financial Advisor for Ally Wealth Management. That is a stunning picture of my office here in South Perth. in Western Australia. And I suppose the key fundamental behind why Ally was set up, it's because regardless of whether Australians like to pay tax or not, they generally at some point still feel a very homely connection to Australia. And so Australia, when it forms part of their life, is always going to be front and center. So that comes down to, what do we do with Australian assets? And lots of Aussies love things like property, superannuation investments, and they just generally have really good ties to Australia. So essentially setting it up so we can service Aussies no matter where they live in the world, and focus on what's important to them, and making sure that should they do return back to Australia in future, that they're set up just as good as a reason as to why they left in the first place.
Now, a little bit around the areas we cover. Again, it is very detailed, and Joel and I do work together when it comes to a lot of these areas, whether it's looking after kids, estate planning, testamentary trust, bloodline trusts, insurance inside super, how to structure property ownership. There is a great deal there. As I said, we will be covering snippets of it on this webinar this evening, but there is a great deal that we look at. It's not just go and buy these shares because we think they're cheap. There is certainly a lot more to it. But that's enough about us. Let's dive in to the material. So, Joel, we can start with yourself in terms of what's happening in Australia when it comes to superannuation.
Sure. So superannuation naturally is, without a doubt, one of Australia's most tax effective retirement vehicles. I generally like to educate anyone that I come across, because what we tend to find is people get hung up on the idea that superannuation is an account itself. Like it's like, I'm with Fund A, Fund B, Fund C, whatever they are. There is hundreds on the market, but superannuation is not just an account, it is a tax structure. And so the way in which you can use this to your advantage, without a doubt, can improve the financial well-being, particularly now and into retirement particularly. So just obviously some things to touch on here in this slide. First, we'll touch on contributions. So contributions into superannuation, if you're working and living in Australia, like I am here, I get paid my salary and I get superannuation contributions that go on top of my income, and they're paid to my preferred superannuation account. Now, that type of contribution is considered a concessional contribution. So if you're offshore, you can also use concessional contributions for potential to negate any sort of tax income liabilities that you incur here in Australia. So that could be something if you have an investment property in Australia that is, say, positively geared. So that is the rent that you get from that property is more than what essentially all the expenses are. The ATO will charge you tax on that difference. So you could potentially use concessional contributions to negate that tax. So the concessional contribution cap at present, and I'm not hearing any, I suppose, rumblings of it changing anytime soon, is still sits at $27,500 per annum. In addition to this, if you're potentially approaching retirement, or at a stage in life where you can get access to your superannuation, it might be worthwhile to start pumping in some additional contributions, and that can be done via non-concessional contributions. So the non-concessional contribution cap is up to $110,000 per annum, and basically all this sort of contribution is where it personally derives no tax benefit to you. It's just you topping up your funds. Now, there is also additional ways to, I suppose, put additional funds into superannuation via carry forward or bring forward rules. So at any sort of point, if we look at the non-concessional side, yes, the annual cap is 110,000, but you also, based on obviously if you have the right or a super balance and your contribution history, you could potentially add up to 330,000, or triggering 3 years in one go. So obviously with timing, let's just say we fast forward to June next year, On the 28th of June, you could do 110 and then 330,000 on the 1st of July. So that's essentially a good way to really beef up your superannuation account in, say, for example, in transition to retirement. And then we've got the concessional contribution. So in the, I think it was the 2016-17 budget under Malcolm Turnbull, he introduced legislation where basically you could use unused concessional contributions to go all at once. So the past 5 years that have happened this year, any unused concessional contributions, you could also do a contribution in one go. Where this could be quite advantageous is if, for example, you move back to Australia, you've become a resident again, or even you're a non-resident, and you, let's just say you incur a CGT liability. So you sell an investment property, and that might mean that you have to pay capital gains tax. Whereas you have this available cap to to use all of the carry forward concessional contributions in one go. This might be able to be quite a useful tool to reduce your tax income here in Australia or your CGT liabilities. Or you could just use it if you're earning a really good income when you're back in Australia and you've got unused concessional contributions from prior years. You could just essentially use that as a way to bring down your taxable income. So you can see there from the pictures on the lower half of the slide, an account-based pension. So we've put there that $1.7 million figure there as a good tool, because that's under current rules, the maximum amount that you can have inside a pension account. So if, for example, you were in a full retirement stage and you were drawing a pension from your income, the advantage of superannuation particularly then starts to become very apparent, and that is full tax-free status. All of your income that gets paid from your superannuation account is completely tax-free. Any dividends, distributions, capital gains inside an account-based pension, all 0% tax. So that can be a very useful tool in a way of essentially parking up to $1.7 million of your wealth in Australia completely tax-free. And so when we look at, what do we do with that wealth? Obviously, superannuation, has a full range of investments. This is, if you're, let's just say, with a very large, maybe industry or retail fund, it might just look like balanced or growth or conservative investment options. But, there are obviously a full range of other providers and other investment options that can incorporate into your superannuation and potentially give you a lot more control and flexibility surrounding your investment strategy for your superannuation. You can then even potentially, if you're back here in Australia, look at the self-managed super fund line if you wanted to incorporate quite exclusive or quite or direct property holdings, quite exotic assets, such as like artwork, if that was your particular area of expertise. So from an investment perspective, essentially the options are endless when you've got superannuation. But obviously we just need to take into consideration that about the treatment of those and whether they get locked up. So yeah, if we were to have, for example, a $1.7 million investment property in your own personal name, you can see there under that same scenario, you can see a varying tax outcome. Now, you could even have an investment property inside something like an SMSF, paying $80,000 in rent. But if you're in pension phase, that would also be completely tax-free. So there is obviously lots of tools, lots of investments, lots of varying platforms, providers that provide a full range of assets and what we use to build that up. So this is just highlighting some of the key changes that have happened as of recently. So because of coronavirus, when this first happened in 2020, the minimum drawdowns extended. So that is just impacting clients that have account-based pensions currently. under current or prior rules, the minimum drawdown from, say, age 60 to age 65 is 4% of your account balance. The Australian government, as a way of, because we've gone through such particular market volatility since sort of March 2020 till, well, even today, really, they halved the drawdown. So that's now sitting at a minimum drawdown of 2%. But of course, under account-based pensions, you can essentially draw as much as you like. SG contribution rates have increased from 10% to 10.5%. There is projections that will continue to rise all the way up to 12% by, I believe, 2025 to 2027. So that will continue to go up. Downsizer contributions age reduced from age 65 to age 60. So that allows you to have an additional contribution that is exempt from your either concessional or non-concessional contribution caps, which basically means if you've held your primary residence for up to 10 years, you can then downsize your home, sell it, and funnel an additional $300,000 into your super without impacting any of the other caps. A big one, which came out of the sort of last coalition budget, was the work test being abolished. So previously, if you were going to want to make super contributions beyond the age of 66 or 67, you would need to meet a work test, which is working 40 hours within a 30-day period. So they've abolished that up to age 74. So that's really good for potentially Australians that come into money slightly later in life. Let's just say intergenerational wealth transfers as well. This is a good way of potentially moving some of that capital if you've received an inheritance into essentially a tax-free environment. And then again, the concessional contribution carry forward remains. That's what I was touching on earlier. So this just highlights essentially taxable Australian property. Now, we've got the poll coming up that most of you are expats. So if you own property outside or in Australia and whilst you're living abroad, if, for example, your property is positively geared, this just sort of highlights the benefit. So, for example, if we had there a taxable income, so that is net income from your property, $25,000 is your positive cash flow from your property a year. And under the non-resident tax rate rules, you would pay 32.5% tax to the ATO on that $25,000. So potentially what you could do is, because the concessional contribution cap is $27,500, you could make a contribution of $25,000, reduce that taxable income down to essentially zero, which would, instead of paying $8,125 to the ATO, you would pay no personal income tax, but you would pay still your concessional contribution tax, which is levied through your fund, and that's at 15%. So you can see there you've essentially gained a 17.5% tax benefit. So a good tax arbitrage opportunity there of potentially up to $4,375 under that example. So it's good to know that if, for example, you do have property, if we're rolling into June, it's probably a good time to touch base with, your property manager or your accountant, sort of to say, right, forecast in June, what is the rent that I've received sort of year to date? What is the expenses that I've incurred year to date? Is there a gap? Is there a positive cash flow or positively gearing scenario there? What potential contributions can I make to minimize the impact of personal or non-resident income tax here in Australia? Carry forward rules for expats. So again, I touched on this a little bit earlier. So just to be mindful of the rules around these sort of carry forward concessional contributions. So for the first rule, it's just merely has your total super balance. So that could be your total super balance amongst all of your accounts. It's not just so the ATO records your entire balance. You could have 10 accounts, but all of your accounts together need to not have a combined balance in excess of $500,000 as at 30 June the year before. And you could use this, you could use that contribution. So that would be just merely exceeding your concessional contribution cap in any year, and it will automatically trigger that bring forward provision. So under I think this is now would be the sort of first year that you can trigger up to 5 years all in one go. So under, let's just say worst case scenario, that's, you know, back in 2016-17, the contribution cap was 25K, so 25, 25, 25, 27.5 and 27.5. So essentially, like, that's a pretty good healthy window to get up to potentially what, $230,000 closely. So that's, you know, a good opportunity if you need to negate any sort of large tax liabilities, because if you were paying non-resident tax rates at 32.5% starting rate versus 15%, you can see it would make a significant tax saving.
Brilliant. Thanks, John.
Do I have any other points, or have I harped on enough?
Look, I think that that all makes a great deal of sense. I think a lot of expats sort of get a bit, and, you know, we all sort of fall into the trap of assuming that Australian tax is awful, and in simple terms, I would have to agree. But when you actually start considering some of these strategies, putting some detailed plans in place rather than just paying your PAYG tax as the ATO demands, that you can actually bring down that rate to a pretty healthy balance. So no, that's very helpful. Now, moving on, as I said, if you have any questions on the super front, feel free to drop them in the chat or the Q&A. But otherwise, mindful of everyone's time, we will continue on. Now, tax residency. So a bit of an update of what's happening here for anyone who's heard me talk about this, published blogs, articles, videos. We've sort of been on this since the very beginning. It has been going on for a couple of years now. And this was originally proposed in 2019 to change the way tax residency is determined in Australia, because the view was that, you know, it is an overly convoluted and complex area. It hasn't been updated in, well, nearly 90 years. A few things have changed over that time period, naturally. So it was certainly time for a bit of a refresh. So where we are at currently, we expect that there should be a bit of an update in the mini budget that will be released later this month. So in about 2 weeks' time, we're hopeful that we'll get an update from the current Australian government to outline exactly how they see this all working. But in very simple terms, this is basically how the flowchart is going to work. So rather than going through all of this step by step, it is relatively simple. If you reside as a tax resident in a country that does not have a double tax agreement with Australia, and that is does not have a double tax agreement, so Hong Kong, most of the UAE, Dubai, various other countries around the world, there is no double tax agreement with Australia. Now that means that there is no tiebreaker test to determine that you cannot be a tax resident of two countries at the same time. So if you are a tax resident of, let's just say Hong Kong, for example, then if you spend more than 44 days in Australia, that is 45 days or more, then you need to consider the factor tests. And this is what would determine if you are deemed to be an Aussie tax resident. Now, you can see the factor tests at the bottom here. The first one is, do you have the right to permanently reside in Australia? Now, this could be anything from a vacant property, i.e. something that you don't have rented out. It could be a timeshare. That is a right to permanently reside in Australia. And it also means that you either have an Aussie passport or you're a permanent resident of Australia. Either of those is going to tick that box. So naturally, that one is a bit of a catch-all. The next is Australian accommodation. So again, here's where timeshare investment properties come in. If your investment property is tenanted, and by that I mean on a commercial basis, That might be Airbnb, but it might be Airbnb not because you want to boot them out every time you go back and stay there, but simply because that's the best way to rent it out, because it's a holiday property and you can earn more money doing the Airbnb strategy. Or it might be that you've got a 2-year lease signed and your property's rented out. That wouldn't meet the Australian accommodation test or factor, as we currently know it to be. The next one is Australian family. So do you have family that reside in Australia? Now, this would be spouse, would be a big one here. Tax residency is an individual test, but if your spouse resides in Australia, that may flag this factor here. The other one could be dependent children. Now, what we're waiting to uncover a bit more information on is, what if your kids are boarding in Australia? Does that mean that you fail this factor? And that's what we're hoping to have some light shed on when it comes to the upcoming budget, exactly how this is going to play out. And the next one is Australian economic interest. So this would be things like, are you randomly sending cash back to Australia that gets sat in a bank account and doing nothing? Because in the ATO's eyes, the Australian Tax Office, they would look at that and say, well, would a Singaporean randomly transfer cash back to Australia? No, they wouldn't. So why is an Australian citizen living abroad doing that if they're not actually an Australian tax resident? Now, if you're transferring that money to Australia and investing that in shares or property or a term deposit or whatever else it may be, there is a commercial interest or commercial strategy behind transferring that money. Again, a different story. So watch this space. We're hopefully not too far off something along these lines coming in, but do be mindful that if you are a tax resident of Singapore, thankfully we have a double tax agreement in place, and the entire crux or rationale for a double tax agreement is that you cannot be a tax resident of more than 2 places at once. That does not mean go and spend 182 days of the financial year in Australia and roll the dice and sort of wave at the ATO trying to do the wrong thing. You still need to tread with caution, but it does mean that the 45 days is not going to apply. So that is what we currently know. It is a little bit more than we previously knew as in terms of how these factors may work. But as I said, hopefully we'll get a bit more information there. We are very hopeful that the 45 days doesn't apply and that instead we get something more reasonable like 90 because 45 is just ridiculous. But we really are in the government's hands now. We have been lobbying, speaking with various politicians. But again, it is very difficult if they haven't spent any time as an expat to get them to understand exactly what expat life is all about. So we watch with interest with what's happening there. Now, on the tax rate side, Joel, I might throw back to you just to talk through exactly how the tax rates apply and what they mean for expats.
Sure. So obviously, if probably more, most of the attendees are living in Singapore or likely in lower tax jurisdictions. Welcome to Australian resident tax rates, which is what I suppose all of us resident taxpayers need to be mindful of and what we are paying currently. So you can, now there is a proposed, well, it's very heavily debated if you're following Australian news. So the stage 3 tax cuts, which were originally proposed by the coalition government, it'll be interesting to see whether they are proceeded with or whether they are reversed, depending on which paper in Australia you're currently reading will, I suppose, ultimately determine the outcome of that already. But what they're essentially proposing of what we can see under the resident tax rates between 45 and 120 or up to 180. I believe it's what was proposed was from 80,000 to 180,000, being a flat 30% tax. So that obviously is a significant tax cut for some people if you're earning, probably making a more impactful difference. If you're earning in excess of 120, say $1,000, you're essentially bringing down 7% tax on any surplus income that you're earning. So As a non-resident, however, just moving that aside, whereas me currently being a resident in Australia, I gain benefit from things like tax-free threshold, which is that $18,200 where I would pay no tax. And then it obviously tiers up. As a non-resident, you're implied from the first cent or first dollar that you're earning, you're going to be paying 32.5 cents in the dollar. So as a non-resident, any sort of rental income, CGT, you're still obligated to lodge a tax return to the ATO, and you would pay obviously interest or withholding on any sort of interest or dividends or unfranked dividends that are paid to you. So, and you wouldn't be required to lodge a tax return. So that's obviously being very mindful that if you are going to relocate back to Australia, particularly in future, you need to be mindful about your tax obligations, particularly as when you're starting to transition to become a resident again from a non-resident, and whether that's structured and how that's structured while you are a non-resident before you do come.
Brilliant. Probably, I guess, just worthwhile highlighting here for anyone, and I'm not sure if it would apply to anyone on the webinar this evening, but just, as Joel sort of highlighted there is that withholding tax on the unfranked dividends of the 15% in Australia. So if you have bought a large portion of shares in Australia that are paying, a reasonable dividend, there is a bit of an arbitrage for expats where you could sell them prior to that dividend record date, buy them back post-dividend or ex-dividend, and effectively you're just picking up that differential because the share price will naturally drop by the dividend amount, give or take, and avoid paying that withholding tax. So if you've got $1,000 invested in, BHP, for example, complete waste of your time. But if you've got a larger portfolio with some, fairly hefty positions there, certainly something to be mindful of, particularly while the Aussie dollar is very attractive for expats at the moment. Probably not so attractive for Aussies wanting to take holidays overseas out of Australia at the moment.
No, not now.
Unless you go into Europe or the UK, of course. Now, when it comes to structuring your investment, so this is a big one and certainly a critical area of a lot of the advice that both Joel and I are working on with our clients, whether you're a Singapore tax resident or a tax resident of a different country, looking to move to Australia, not looking to move to Australia. There is a lot to consider here. But these are essentially the options that we have to sort of think through to work out what's going to make the most sense. And we won't sort of go into all of the minutiae of all of them because this is just a 1-hour webinar, but just to give you a bit of a high level overview, the first is the insurance bonds. So this is effectively owning a life insurance policy that owns the investments. This can be tax effective. In Australia, what you need to be very mindful of here is that they're not loaded with commission. That is at the discretion of the insurance company or the advisor that you're working with, and they do have the discretion to basically rebate or wipe out that commission. So just be very mindful there. The structure has a bit of a bad name, largely down to a few bad eggs doing the wrong thing in the advisor world, but can be a sensible structure. Again, just depending on how you structure things. We then do have family trusts, both in Australia and in Singapore, and in a lot of other countries for that matter. Again, something that can make sense. Asset protection is probably the biggest driver for a lot of these nowadays. Gone are the days where you could allocate income to your cat or dog or unborn child that you were thinking you might have in future. So give some thought here. Being a trustee of your own trust is a legal strategy, but something you need to be very aware of what your obligations look like. Even though it may be your trust for your benefit, you are still potentially the trustee with a legal obligation to act responsibly. You've then got companies you can set up both in Singapore and Australia. in many cases, it's a little bit like the trust. It's very good, or can be very sensible from an asset protection viewpoint. Doesn't do a great deal when it comes to tax in most cases. Again, I say most cases because it is very much a case by case and may make sense for you. We then have individual joint direct ownership. So by that, I mean shares, ETFs, managed funds in your own name. Now, if you're sitting in Singapore, you've accumulated a bunch of shares. If you go back to Australia, and Joel, correct me if I'm wrong here, you then go through what is called a deemed acquisition. Now, you don't actually need to sell them. There's a lot of sort of myths that we hear every now and then that you have to just sell your shares the day you fly out of Singapore and buy them back the day after you land in Australia, which is complete and utter garbage. All you're going to do is make the brokerage happy, paying the trading fees, but you will be deemed to have bought them. And then you'll be exposed to tax in Australia at whatever your marginal tax rate is. Now, that doesn't mean the day before you fly back or the week before you fly back, you start making changes, because the ATO may frown upon such moves. Why have you done it? Tax avoidance might be the obvious answer. So again, if you are thinking of moving to Australia, and so just going back to our earlier poll, I know a few people have highlighted maybe 1 to 2 years, start giving this some thought now, because the more time you have, the better. Joel's already highlighted the limits around superannuation contributions. If you have even 2 financial years that you can cross, that can make a very big difference tax-wise. So it's not a case of reach out to your advisor 3 months before and start having the conversation. Reach out a year or 2 before, if possible. The advice may be you don't need to do anything yet, but the advisor is going to be a lot more comfortable. Certainly speaking for myself, and I think I can probably comfortably speak for Joel here as well. We don't want the call the week before or a few months before. We'd much rather be putting those plans in place early. Joel, anything to add on the structuring side of things before we move on?
No, you were just touching on obviously deemed acquisition as well. I suppose only thing worth highlighting that if you go back overseas again, let's just say hypothetically you move back to Australia for an extended period of time, and then you think, do you know what, I'm paying way too much tax here, I might go back. You then need to be mindful whether you do a deemed disposal then. So that would be during the time of that happening, what are the gains? What are the tax implications there? So that can be another thing to consider as well, and what the appropriate structure is for your investments if you're planning to potentially leave, or sorry, come back and then leave again. So it's just being very mindful of that.
So any questions on the structuring tax, fire them through. I know there's a couple of things coming through, but we might leave a couple of those to the end. Otherwise, we will push on to the property side. Now, we're not going to touch on here price falls, what areas, where is their value, because otherwise this webinar will never end. And the media is doing a good enough job of sensationalizing every little movement that we're seeing in the property market. I mean, gosh, if you only read the headlines, you'd never do anything. We are already seeing price drops built into current transactions. And in Sydney, Melbourne and Brisbane, they're realistically between about 10 and 20% already off the recent highs. So we're not expecting that there's going to be a great deal more change there. And everyone we seem to be speaking to is just waiting for the prices to correct and waiting for the prices to come down. And what they sort of seem to be failing to realize is that if everybody's doing that, the prices may not actually come down, because everybody's waiting with their cash, with their loan pre-approved, ready to go. Now, there is a great deal happening. Just want to cover off a few critical things here, particularly around some of the tax changes that have been announced. We'll talk a little bit around some of the financing strategies and what's sort of been proposed here. I've highlighted land tax here. Land tax is an interesting one, but the big change that was proposed recently, which some of you may be aware of, was Queensland decided that they would like to, instead of just basing your land tax obligation on the amount of property that you owned in Queensland, they would instead base it on the amount of property you owned right across the country. You would still only pay tax on your Queensland portion of land, but the tax band that you were in would be based on the entire value of the asset. So if you own a property in Sydney, Perth, Melbourne, and one in Queensland, you may very well be in the top tax bracket. To put it in perspective, just a very simple scenario, let's just say you own a property in Brisbane worth 600,000. The land value is worth 600,000, which is the current tax-free threshold. So that means that if your land is worth 600,000 or less, you pay 0 land tax in Queensland. Now, if you also own a property in Sydney that has $1 million land value, your tax bill would have been, under Queensland's proposed rule change, about $5,500. Now, that's a big smack in the face for nothing having changed other than the Queensland state government thinking it was a good idea. Thankfully, cooler heads prevailed, and Dom Perrottet of New South Wales was probably one of the biggest drivers here. The Queensland Revenue Office basically wanted all of the other state authorities to report on their own citizens or constituents of the state with their property or with their land values, which would have meant they would have had to put on more staff for no revenue to report on their own people. So basically told Queensland to get stuffed. It was never going to work. And even if it did get somewhere close to working, probably would have resulted in double tax. Not to mention the fact that Queensland has a ridiculously low vacancy rate and rental properties are being listed for about 2 weeks at the moment before they're being snapped up. So an awful idea, but the reason I highlight that is just to give some thought to how you're structuring your property. If you are looking at property as a source of wealth creation, retirement planning, consider the entity you own the property in, consider buying in different states, different names, trusts, whatever it may be, because no doubt rules are going to change again. And we've touched on a few of the potential changes, a few of the recent changes. Change is probably the one certainty when it comes to financial planning. Certainly keeps Joel and I in a job. So that's sort of what's happening on the land tax front. Now, a couple of things on the tax side. Again, Joel's highlighted already the super contribution strategy that you can utilize to offset the taxable income on your rental property. What you can also do is the same thing when it comes to the interest on your loan. So if you do have again, let's use a positively geared property as an example, and let's just say that property is generating $20,000 a year in net rental income. That would mean, again, tax bill, 32.5%, that's $6,500 in tax. Instead, what we do, we call our friendly mortgage broker or call our bank. We explain to them what prepaying interest is, because a lot of them will not have done this before, but it is a relatively simple strategy. You need to make sure that your loan product allows for it, because not all of them do. And you can prepay up to the next 12 months. You could prepay 6 or 10 or 12 or whatever number you like, but only up to the maximum of 12 months. And you agree on the rate at the time, and you claim that as a tax deduction. Yes, it does mean that you need that 20,000 or whatever number that is available to do this, but you could potentially even just take it out of your redraw facility, pay down the interest, claim the deduction. So there's a lot of ways you can play this to simply minimize your current and potentially future tax bill. Now, just to sort of talk through, I guess, a little bit around some of the financing strategies. A couple of these are incredibly important at the moment, not so much strategy 1, more so strategy 2, because what is happening in Australia, and I'm sure most of you are aware, particularly those that do have a property in Australia, interest rates are rising. We've gone from the low 2s last year to most variable rates now sitting in the high 4s and even the low 5s, and fixed rates sitting in the 6s and 7s. The world has changed. Rates will continue to rise, in all likelihood a little further, but probably not as aggressively as they have been lifted this year. The reason I highlight that is because it's also getting a lot harder to borrow money. So every 1% that the RBA lifts the cash rate, that's the Reserve Bank of Australia, your borrowing capacity, whether you're an expat or a resident of Australia, drops by about 10%. So if you could borrow $1 million last year, now it's probably more like 750,000. And next year it might be closer to 650,000. So if you're looking to either refinance, access equity, set up a little bit of a buffer in terms of an equity access loan or a line of credit, last year was the time to act, which is the very unhelpful comment I'll make. But if you didn't do anything last year or earlier this year, it is time to review this now, because it's not going to get easier, it is going to get more difficult. APRA will probably come in, my one sort of political prediction or regulatory prediction over the next 12 months, and likely reduce the serviceability buffer. That is the buffer that they impose on banks to make sure you can afford the loan at. So currently that's 3%, which means that if the bank's going to lend you money at 5%, they need to make sure that you can afford it at 8%. So 5 plus 3. They will likely need to bring that down to maybe 2 or 2.5, because otherwise nobody's going to be able to borrow any money anymore. But again, it's not going to mean that you can borrow more next year. It's just going to mean that perhaps the change is not quite as painful. So a few things to consider on the financing side. If you are sitting on a large amount of cash, unsure what to do, you can look at substitution of security strategies whereby instead of simply putting your cash into a deposit and buying an investment property, you can instead fund that through a term deposit, draw down the line of credit or the equity access loan from that term deposit, fund the deposit that way, and then do a substitution of security. Again, I'm very mindful of time here and not to sort of go into all of the minute details of this strategy, but in very simple terms, it's just a way of converting non-deductible debt to deductible debt and putting some of your cash to work, particularly if you're not sure when you're going to be back in Australia again. Now, the other one I highlighted, which is the far more important one, is if you are looking to access equity, and now it doesn't even need to be that you want to use this equity in the short, medium, or long term. This could just be simply creating a buffer for something that you think you might want to utilize in future. So in this example, let's just say we've got our ex-principal place of residence, the property we lived in Australia before we left. It's worth $800,000 and we've got a mortgage of $350,000. Now the banks will let us go to 80% of the value of that property. So we could borrow another 300,000, 290, which would take us to 640, and utilize that $290,000 as a giant facility that we can draw down on in future if we wish to. That might be to go and buy another property. It might be to renovate. It might be to invest in shares. Again, make sure you seek advice here. Speak to your advisor. There is a lot you can do with it. It should not just be a slush fund or something that you go and utilize to spend on your everyday living expenses, because what that also does is it makes it quite a mess when it comes to what is deductible and what is not. So again, make sure you're keeping this clean, simple, as much as possible when it comes to accessing equity. But as I said, if you are going to do it, make sure you do it now. So that's a bit around what's happening on the property front in Australia. Let's have a look at markets for 2023. And Joel, I'll throw back to yourself to sort of walk us through the first couple of components here and where we're seeing opportunities in the market.
For sure. So I suppose probably the first slide of that was a little bit maybe perhaps incorrect, because it said for markets for 2023. I've lost my crystal ball, so I don't know. I can't tell you, sort of where we're going to end up in 2023. But what I wanted to, I suppose, really point on is this slide sort of shows a lot here. And this is saying, are equities expensive? So that is the price that we're paying for the equities. What is it? What is their earnings? What are the value of those sort of underlying equities? And if you look back there, 1998, obviously GFC, and then 2008, the tech booms, and even now into fast forward 2020, 2022, we've got coronavirus. You can see there that the relative same levels are apparent. So from a price perspective, from equities, it's a good time. So generally speaking, we like to see, we see nice steep inclines in equity performance after significant events. Now, I'm not going to say that that's what the repeat is going to be, but it's more or less a good time for potentially, I see a lot of value in that sort of long-term money space. So anything that's, potentially lazy capital that you've got hanging around now that, you may not need to have access to for the significant time in future, well, this might yield a very opportune moment to derive that sort of longer term return, particularly as well as inflation continues to potentially pick back up. We then look at what sort of that long-term impact of those equity markets are. Sorry, Jarrad.
No worries at all. So yeah, while Joel's quietly dying there and hopefully regaining his voice, the biggest driver of the volatility in this market at the moment, the biggest driver of headlines, has been the fact that inflation has caught everyone by surprise. And this really started with Russia. The conflict between Russia and Ukraine meant the oil price obviously skyrocketed. Anyone buying petrol or catching a flight or anything else naturally felt that. We then had the trade constraints as a bit of a hangover from COVID. And naturally, with the fact that there has been zero immigration into most countries, Australia is a great example that is a country heavily reliant on immigration coming to fill both low and high skilled jobs. All of this has meant that inflation, instead of being the 2 to 3% that the central bank would like it to sit between, has been more like 6, 7, 8, 9%, depending on where we look. Now, the big question is, well, with that high inflation, should we just be sitting on cash? What should we be doing? And this is, to Joel's point, well, historically, when have we seen very high periods of inflation? This looks at very close to the last 100 years. So starting with 1929, what did markets do during these very high periods of inflation? And you can see there's quite a range. The majority have been quite positive, but you can see there that the average over that time period has been 11.5%. Now, that doesn't mean that you should be just going out and buying everything, because I think one of the critical factors in this market and in this environment is the fact that interest rates are obviously rising, as we've kind of covered on the property front. And that means that any company that's been heavily reliant on debt funding, debt financing, largely free money for the last 12 years, is going to start to feel the pinch. So anything operating on razor thin margins with lots of debt may be in a world of hurt going forward. So we certainly think it's a bit of a stock pickers market, or certainly being selective with the investments you're looking at, and sort of peeling or lifting up the hood and actually having a look at the company financials in this environment, I think is a lot more important.
Thanks, Jarrad. Sorry, just the only other thing I wanted to chime in there just before I started dying was, as well, back on the time frame of investments. Whenever we're thinking about this, again, I don't think particularly even now we're going to see sort of any opportunities to make a quick buck. So anything that you are investing in, you would ideally, or in our portfolios that I'm managing, I want to have, again, what Jarrad said, good quality companies, but with a sort of a realistic time frame horizon, because to ride out any sort of volatility that would happen between, in the short term. This map, I suppose, or this graph just really talks about where we see undervalued assets in the market. So you can see there a lot of the world at the moment, relatively same position. We've got a lot of cheap equities in the market as we see it. So depending on where you want to, I suppose, focus your investment strategy, there's potential for lots of opportunity for capital growth, and sort of that long-term wealth making position.
Excellent.
Oh, there you go.
Sorry, that's okay. So the other thing we'd like to look at, everyone's probably heard the quote of Warren Buffett, greedy when others are fearful, fearful when others are greedy. CNN put out this fear index that they update every month. So this is as at the 10th of October, so Monday of this week. This is where the index sits. So this is a survey of quite a large number of retail and institutional investors, but largely retail, to look at how is everyone feeling about the market. And you can see there previously, a year ago, 1 week ago, 12 months ago, coming out of COVID, this has been bouncing around within that extreme fear category for quite some time. What does that mean? To Joel's point, be sensible with your timeframes. There is quality out there, because when everyone's panicking, when everyone's worried, when people are saying, well, should I just put it under the bed? When mainstream newspapers like the West Australian or the Herald, when the front page of that has anything to do with finance, it's a pretty good time to be paying attention if you're an astute investor, because naturally that is what the masses are talking about. Again, looking at how have markets bounced following various crises. So what this looks at is basically how much did things drop initially. So if you look back to COVID-19, the 87 crash, the Gulf War, the Asian financial crisis, I mean, we've had so many events over so many years, but markets have bounced back a lot faster than often people expect. And that downturn, or that sort of blip, if you look at the long-term chart in the markets, is getting shorter and shorter because we absorb information a lot faster, companies can grow a lot faster. And to Joel's point, identifying those quality companies with good quality marginal economics, i.e. marginal revenue exceeding marginal cost, they can scale quickly, low debt, good financials. We would expect that any period in this market, quality investments are going to stack up fairly well in time. Again, return-wise, if you look at what sort of happened over the last decade, this sort of looks at how things have compared. Aussie equities have actually performed exceptionally well. We have had naturally a bit of an uplift there with commodity prices have been very strong. But again, what this sort of highlights here is, well, how much risk are we prepared to take on for the expected return? And these sorts of charts, this sort of data you can look at both retrospectively and it's obviously forward-looking. So again, even within global equities, for example, well, where in the globe is the most value? A lot of people have been talking about the pound lately. I think if you, we put out a bit of an update just recently, Joel, looking at, well, if you were looking to take advantage of the weak pound and weak UK economy and disastrous leadership that the country currently has, it might be a good opportune time if you had British debt or were planning to retire in the UK. But if you were just trying to trade and speculate around where the pound might go, that might be a bit of a fool's game going forward. So again, there's always two things to consider there. Where are you going to eventually retire and spend the money you're investing? And where is there value in the market? Where is there going to be growth? And to Joel's point earlier, the entire global map looks cheap. Diversification is often critical, but identifying where there is the most value in these markets is often going to yield the greatest long-term results. What we're also seeing at the moment is a big push into value stocks, value companies, value investments. Now, value investments are typically those companies that are trading at low values relative to their fair value, what the business is estimated to be worth. So trading at low price earnings multiples, price to book multiples, however you decide to value a company or an investment, these are the ones that are relatively cheap. And for the last 7 years, really the last 12 years, value investing hasn't worked as a strategy, particularly when you compare it to growth investing. And the reason for that has been that money has essentially been free. So any company, and tech's been a great example. We look at what happened during COVID, a company like Peloton, Peloton the bikes, probably a product that will be out on the verge for collection in the next couple of years, worked very well during COVID. very well funded with a lot of other people's money, trading at ridiculously high prices. Is that sustainable? Probably not. That's not a recommendation to go and short Peloton, by the way, but it is just highlighting we need to be a lot more considerate around what price we're actually paying for stocks at the moment. We're seeing big names in that undervalued category, companies like Verizon, Meta, HP, Intel. There are so many names that are now fitting within this undervalued category, just given the fact that the baby's sort of being tossed out with the bathwater at the moment. So lots of opportunities. And Joel, I might just let you take us through this sort of final piece of the focusing on the long game when it comes to investing.
Of course. So back to my earlier, I suppose, key point is that no matter what sort of investment strategy that you're going to go under, diversification is always, I believe, is going to be key to, I suppose, any sort of long-term success, and not sort of having all your eggs in one basket. But this just looks at really the long game. So this one's that's 1991. So that's when that chart started. So that just shows you, if, for example, you did nothing, you just invested some money back in 1991, what that would look like today. So you can see there, obviously, if you cash, you've got some cash there being the light grey figure. Well done. You've just overtaken CPI a little bit there. So we're still doing about 20K on cash as the net return there. And then as well, but then looking at US shares, Aussie shares, listed property, they're all there sort of as our top winners naturally. And that's just going to be investing really with that long-term horizon and thinking, what do I need my money for? What sort of assets do I have in my overall financial world that I can pull on if I need some sort of, I don't know, emergency supplies? What are the assets that I've got in my position that I want to have for the long term, that's going to continue to make sort of that long-term financial sense, that long-term wealth projection, that long-term growth. It's really important to always keep them in mind and understand what the purpose of them is for. And then, using your rather more defensive assets like cash, bonds, and any other, I suppose, assets that you can pull on in those short terms to make sure to prop up any sort of immediate short windfalls that are needed.
Brilliant. Thanks, Joel. So before we throw over to questions, just by way of sort of wrapping up, obviously there's been quite a lot. We've covered quite a lot of content, quite a lot of different areas through the webinar this evening, and that has been by design. So hopefully everyone's got a lot out of that. But if you would like to book in a chat with Joel, myself, both of us, we will reach out with a link tomorrow. So feel free to book in a time. There is no obligation. We don't charge for that, just to explore how we might be able to assist, or even just to go through any personal questions that you might have in a bit more detail. But thank you very much for tuning in. I know we've got a couple of questions here. So let me just bring these open here. Okay, so first one, all right, so Joel, just one to throw over to yourself around the Aussie tax side of things. So this one's just around owning, well, essentially the deemed acquisition that you spoke of earlier. So somebody's got a portfolio of shares or ETFs, managed funds, I guess, living in Singapore, moving back to Australia. How far in advance, or how much sort of notice should they be planning ahead with when it comes to changing the ownership of those structures? The question here references trusts, but I guess the same sort of thinking would apply for any change.
Of course. So again, proper planning is really important here. You don't want to be ever sort of caught out in a position, particularly with the ATO, that, for example, you've got all these assets and, the day you arrive back in Australia, you start, frantically trying to reorganize your life to try and avoid tax. unfortunately, the ATO will likely probably catch on. So it's being very mindful and planning for what is to come in, I suppose, your own sort of financial worlds there. Because as we said, the deemed acquisition, the ATO will deem that you would have acquired them on basically the day the wheels touch down in any sort of Australian jurisdiction. And they will consider obviously the tax impacts and implications for those assets from then onwards. So considering in future, if you know that you are going to come back, there's a lot of variables here. So there's what age are you coming back? What sort of structures can we use? What sort of assets do you have already? So there's lots of points there to hit on, but yeah, basically the sooner the better to start planning for. For example, if you're coming back to retire, what are the assets we're using here? What can we, if you're living in Singapore, Singapore's a very lovely country being low tax, where also we get to, I believe there's no capital gains tax. So that's very advantageous. So can we use any of those assets to then transition into an environment like a trust or like superannuation to then potentially gain long-term tax effectiveness? So again, time frame to the direct question, there's not really an answer that I can give on time frame because it's so unique to, I suppose, personal situations and whatever other assets that need to be considered into your position. But as I said, don't leave it to the last minute. Do not say, don't come to me saying, I'm moving to Australia tomorrow. I need some advice on, I suppose, proper planning. So just be mindful of that.
Brilliant. Okay, the next question, another one for yourself. So the super contributions you talked about earlier around the carry forward concessional, and I guess any super contributions, really just extending the question a little bit further. Is that per person? Is that combined? How does that all work?
Yeah, so superannuation is an account that's completely unique to yourself. You cannot, for example, share superannuation with a spouse or with family. So the contribution caps apply individually. So if, for example, we touch on the concessional contribution caps or the bring forwards, right, that potentially could be for you and your spouse as well. So you could utilize those caps if you've got joint assets or you're doing downsizer contributions, that's potentially each. So you do have a cap in a downsizer contribution, 300,000. You have a potential window there to get $600,000 between if it was you and your spouse. It's also really important that I will highlight as well that superannuation doesn't form part of your estate. So it is, or generally with your will. So you would need to either make a binding nomination within your account and also consider the implications of, for example, total super balances, transfer balance caps, if you're at that higher end and you want to potentially revert pensions and leave estates or leave superannuation money to either your spouse or your non-dependent children, there is definitely tax implications there as well.
Excellent. And the final question here, so just around, okay, so basically timing, I'll just sort of paraphrase the question here. So sitting on a pile of cash, when would you be investing in the market? All right, so I might tackle a little bit of that one. Look, personally, we've had quite a number of new clients come on board over the last 6 months. So if we think back to July of this year, let's just say I'm sitting on $1 million cash in the bank, starting to map out my investment plan in July. We broke that down into 3 or 4 tranches as part of the strategy. So the first quarter went in July, the next quarter will go in about now, and then the following 2 will go in over the next 6 months. Now, the reason we do that is not because we have a crystal ball. Joel, I certainly didn't steal yours, but it is simply there to mitigate some of the risk. We know, historically speaking, history is an excellent teacher, that the best time to buy is at the greatest level of bearishness. Bearishness is an expectation word. It is not when the economic data is the worst, because economic data is often a lagging indicator. So you want to be buying when everyone's scared, when everyone's panicking, and when no one knows what on earth is going on. If we think back to a recent time when that was the case, the beginning of COVID, so think back to February or March of 2020, when Australia was realizing that it wasn't just going to be an Asian flu again, that it would actually impact the rest of the world. And you think about, let's look at the real estate market. Was it a good time to be buying property in Australia at the beginning of COVID? Probably, looking at what's happened over the last 24 months. Now, obviously, in the next decade, we'll be able to answer that with a lot more precision, but it highlights the point that we want to be buying when everyone's worried, when no one quite knows what's going on, but mitigate that risk, dollar cost average to an extent, and don't worry about the fact that if you're a little bit early, a little bit late. You look back at the Amazon share price as a great example. In 2000, traded at around $1. In 2001, I think got down to about 35 cents. If I bought at $1, am I really that upset today? No, probably not. To Joel's earlier point, if I'd put $100,000 in and I needed that 100,000 in 12 months' time, and now the shares are at 35 cents, that would have been a really terrible idea, and I would have paid the price. So being sensible with your timeframes, your investment horizon, I think is absolutely critical. Joel, anything to add there around that question, around sort of timing of investments?
No, obviously the sequencing risk would be just, the key point there. But naturally as well, it again depends on what assets, your other positions, what is the purpose of, again, that money for. So, if it is for that, it doesn't necessarily need to be, a very rigid quarter basis like, what we've done previously. It could be quite smaller if it's okay for, to have initial chunks and then smaller amounts. It really doesn't matter. But it just depends on each unique scenario that, that whatever comes in front.
Excellent. All right. Well, look, I think we are all out of questions there. So thank you, Joel. And thank you everyone who's joined us this evening. As I said earlier, I hope you've got a lot out of it. I hope that's been helpful. But yes, we will send you a note tomorrow. So you'll have both Joel and my contact details there. Any questions, if you'd like to book in a chat, more than happy to do so. But otherwise, have a great evening. And thank you very much for tuning in.
Thanks so much.